Hi, it's Professor Giametti again. We're going to be talking about stocks and bonds in this chapter, in this topic here, lesson number 12. I broke it down into two parts. This is part one. Okay, I want to keep these down to 5 to 10 minutes at most if we can. But we're going to talk about the primary and secondary markets of issuing stock. This course is a 335 level course, so I need to bring it up to a higher level. You may have heard a lot of what we're talking about in these things, but we're going to bring it up to a little higher level than what you learned in your rudimentary courses. Okay. The primary market is where stocks initially get sold. Stocks and bonds, actually. Whereas the secondary market is where already issued shares of stocks and bonds are sold. The primary market is initial placement offerings, IPOs, initial placement offering. That's where the initial sale of securities takes place, usually through an investment banker. Okay, investment bankers sometimes get together and form a syndicate. That syndicate then markets billions and billions of dollars of either shares of stocks or bonds to a variety of investors. Goldman Sachs and Merrill Lynch will get together with Morgan Stanley and Wells Fargo to issue billions of dollars worth of Google stock or Google bonds so that Google can go out and build a huge factory. Okay, that's basically how it works. Whereas a private placement is something that doesn't need SEC approval. It's not public. It's not sellable to the public. It's just to a certain group of investors. Okay. Now, due diligence is what we often call it when somebody such as myself, an investor, goes out and researches stocks or researches various investments and obtains data, research, so that you can determine, is this a good investment or not? Okay. And in order to do that, very often you need a prospectus. This prospectus is a regulated document that is filed with the SEC that contains all of the issuer's operations and projections and finances going forward. The SEC doesn't audit them. They just look at it and say, okay, it isn't fictitious, at least. It's not grossly fictitious. It has some semblance of reality, but it doesn't have to be perfect. These are projections, generally. It must be provided to each buyer of a newly issued security. Obviously, if it's newly issued, they haven't been in business long enough, they haven't had public financing. What are you going to do with this influx of resources? Okay, held in the prospectus. Underwriting deals with in an underwriting agreement, you have a contract in which the underwriter, such as Goldman Sachs, agrees to buy securities at a predetermined price and then sell them to investors. Okay, so there could be what they call an offer price. Okay, and that's the price that they're going to try to sell this to investors. And the spread that the underwriter keeps as his profit is the offering price minus the price paid by the investment banker. So, for instance, we are going to market $10 billion worth of, or a million shares of Google stock. And we are going to give Google $700 per share. We're going to try to then collect as much as we can. So we are going to sell this at a higher price than what we're paying over to Google. Okay? Or the underwriter could say, you know, I'm just going to give it my very best efforts. I'm not going to guarantee you anything. I'm just going to go out there and try to sell this as best we can for negotiated contract price. In other words, go out there and here's $10 million to get the best price you can for Google stock. Okay? No risk to the underwriter. They just do the best they can. Okay? Sometimes a new organization will do what they call a shelf registration. It's a quickie registration where you register with the SEC, a cursory review is done, and you are allowed to sell for a period of 2 years. Okay, this is quite different than a private equity sale, this private placement, where you sell equity, shares of stock, with no SEC approval whatsoever, You just sell it as best you just go out there and sell it to private investors, not the public. Okay. Rights offerings are much like preemptive rights, whereby you can issue new shares and offer to the existing shareholders, so that they have an opportunity to keep their existing percentage, so that they don't diminish their percentage ownership. A Dutch auction is nothing more than investors putting bids in, where the investment banker then plucks out the highest bids and allows them to purchase the stock. Okay. A tombstone is an announcement of securities offerings to be placed in a newspaper or other publication. All it does, it makes public aware that there's going to be this new offering. Okay, they're going to issue shares. This company intends to do that. It generates interest. Okay, we talked about a syndicate, which is a group of investment bankers that are distributing a security. Aftermarket is the period of time after the new issue that's initially sold to the public, and during this time, the members of the syndicate cannot sell the securities for less than the offering price. If things aren't looking so good, they don't want this to bail out and ruin them. Okay. Market stabilization is where the syndicate can intervene to buy back shares to prevent a large price drop. And underpricing is the difference between the aftermarket stock price and the offering price. So if they went out and pumped it too much and then all of a sudden it dropped down after a month, that's that underpricing. Okay. The Securities Act of 1933 basically still guides investments today. It provides full and fair disclosures of what's going on in a business, so that you have a good idea of where a company is heading, what their financing really is looking like. The SEC gets the information from them, but they make no opinion as to the issuance of this stock. It just wants full and accurate disclosures to be made. Okay. And the Security Act of 1934 is what it really established the SEC, and it basically says that anybody who's selling shares has to register with the SEC and has to pass certain guidelines, ethical standards, and so forth. Okay. Brokers buy and sell securities in the market for an investor. They go out and act on the investor's best interest to do that, whereas dealers maintain an inventory of securities that they themselves buy and sell to satisfy investor trades. So they're holding their own inventories. Blue sky laws protect the investor from fraudulent securities investing, fraudulent securities offerings. Okay. Anybody who goes out there now and tries to make a security initial public offering without registering, they're jailed. It's big time bad. The Glass-Steagall Act of 1933 separated basically banking from investing. Commercial banks, based on Glass-Steagall, could not go out and sell securities. So now you have the Bank of America, for instance, that does banking. They also do securities, but they do it through their arm of Merrill Lynch. Okay? And the Gramm-Leach-Bliley Act, which came out in 1999, allowed commercial banks to sell securities, insurance, and other financial products. So it basically lightened up, it loosened up on the Glass-Steagall Act. Okay? Some blame this Gramm-Leach-Bliley Act for what occurred in 2008, 2009. Okay? And that is basically our lesson, part 1, lesson 12. Thank you.